Okay, everybody, welcome back to part 2 of financial planning in volatile markets. This is the important phase where we start now matching your situation to the type of portfolio that you should have. Okay, so let's get into this. Aligning your desires, your reality, and your portfolio. Okay, it's amazing how out of whack this seems to be when people come in. To me, it's all logical, but we need to look at everybody individually, and this is really case in point. So the last part 1 that we went through, we talked about all the different pieces that were important in assessing you and your situation. So now we need to start pulling this together in relevant information. So spending it versus passing it to heirs, whether you have enough money or not, how you're going to use your savings, and your own risk tolerances all play into the type of portfolio you should have to be able to tolerate the ups and downs in the market. Assessing your own situation first is always the priority when developing the portfolio to handle these volatile markets. So, prioritize safety. Who needs to do this? Okay, well, honestly, when you're on the spectrum of spending your last dollar on your last day, that is really pushing you towards stable, safe investing. The withdrawal rate mathematically really needs safe, stable, predictable investments to achieve its best performance. Okay, this is math. This is kind of my spreadsheet geek coming out. I talk about the math that goes behind this, but understand the greater your withdrawal rate, the greater the effect of volatility. So we prioritize safety, the more you're going to be spending this money, okay? You do have to have enough too, right? If you don't have enough, how are we going to spend all this money? You're going to run out of money before you pass away and get mad. All right, so you have to have enough money. And in my math, we work on it based on zero growth. So any growth that we get, even if we're prioritizing safety, is helping us keep up with inflation. So this is for the people that need their money or just want their money. Certainly, if you need your money, you're prioritizing safety. If you want to spend your money, you're actively finding ways to spend your money, then prioritizing safety becomes a priority. Okay, this is your capacity for risk. You have a low capacity for risk when you're in these situations. That's important to understand that. This is not about your own personal risk tolerance. This is matching your situation to the portfolio. Okay, so now there's prioritizing growth. We built our wealth in the stock market. We have relied on the stock market most of our life. Well, who are the people that should have the majority of their portfolio in that stock market? Well, it's those that really do want to pass money to their heirs. That includes the people that, whatever left over, but I want to at least send them this much money. It includes those people. Okay, growth. If we don't need our money, if we have enough and we don't need our money, we can prioritize growth, right? Maybe we can secure some of that IRA because we have required distributions. But other than that, everything can be in growth mode. We got to understand, if we don't need our money and we want to pass it to heirs, we are still essentially in growth mode. This money is not going to be touched for many years. It's going to last your life and somebody else's life. You have enough money. You're not really pulling money out very much. You can prioritize growth. You can handle turbulence. You can hang on for the ride. Okay? So, designing the portfolio one step at a time based on these two situations. We start understanding and seeing the picture of somebody that can prioritize growth versus somebody that can prioritize safety. So now we start pulling this together and start realizing that if you need your money, you need to be on the safe side of this spectrum. If you don't need your money, you need to be on the growth side of the spectrum. And when I say need, I say that loosely because your own personal risk tolerance is going to influence this as well. The greater your dependence on your portfolio for income, the less it should be left to chance. The larger that withdrawal rate, the greater the effective volatility. I think that's the third time I've said that. It's important to get that in your head. It's so important. That's one of the biggest principles of retirement portfolio management, is reducing that volatility in the parts of the portfolio we're making those withdrawals. The statistical rule of thumb that's been proven in the court of law is right around 60-40, 60% safe, 40% stock market is the ideal for those required distributions. And depending on the time period you test it, even 70-30 tends to be the most optimal mix, 70% safe. So somewhere between 60 and 70% safe investments, because required distributions just get bigger and bigger and bigger as a percentage. They start just under 4%, but then they get bigger and bigger and bigger. You're hitting 5, 6, 7% fairly quickly. So that type of withdrawal, you test that through all the markets that we've gone through in the last couple of decades. And that 60 to 70% safe is really the route to go. It's the most efficient to get the most money out of your portfolio. Okay, I know that sounds strange, but turbulence is your worst nightmare when you hit those type of withdrawal rates. So we have to treat each part of our portfolio differently. Just because you need your money doesn't mean your whole portfolio has to have 60 or 70% of it in safe investments. Typically, and I see this most of the time, the withdrawals are only coming from the IRA, as they should in most people's cases. The day you retire, you should be laser focused on that IRA and how you're going to get it out at the least amount of taxation possible. Okay, whether you need it or not doesn't matter. You've got to get it out at the least amount of taxation to be efficient. So even if you don't need it, pull some out and pay taxes on it, put it in Roth if you want to. So everything is taxed as ordinary income in that tax time bomb. So you're going to have to withdraw every year the day you retire. Okay, the more you spread it out, the less taxation you're going to have. Stable investing produces better results when it comes to consistent withdrawals. And this is your heirs' least favorite money. So again, pull every year the day you retire. Roth, this is your heirs' favorite money. It's tax-free, not only for your life, but for 10 years of their life. So we do need to kind of prioritize growth in this part of the portfolio, because if we're going to leave any money to our heirs, this is probably the money. All right. So aggressive growth is fine. I'm not telling you to do aggressive growth. I'm more saying that if you're going to have it in any part of your portfolio, this is a good part, because there's no taxation. You can buy and sell and buy and sell and buy and sell. There's no taxation to worry about. It frees up that ability to trade more fluidly. But you can also use some of these alternative investments, not necessarily private investments, but the publicly traded REITs, the MLPs, even the closed-end mutual funds have different tax structures and make them terrible for your after-tax money, but they're great in Roth for producing income. So those people that want to create some passive income for their Roth, that's a good thing to do in that part. And keep in mind, again, this is your heirs' favorite money. So if you do care about leaving money to heirs, this is the money you want to leave to them. Then the rest of your money, this is why every financial advisor, stockbroker, whatever you want to call us, every one of us needs to understand taxation, because every choice of investment in your after-tax or non-qualified part of your portfolio, every choice we make causes different taxation here. And we don't have to pay that taxation, you do. So you better care whether your advisor understands taxation or not, because they're causing that taxation. So this is really important to understand. We need to avoid things like interest-bearing investments in this part of the portfolio. We need to avoid non-qualified dividends and short-term capital gains in this part of the portfolio. We also need to remember that it's the cost basis steps up upon your death. So if you bought IBM stock in 1927 and you've been holding on to it and holding on to it, now you got $1 million capital gain there. If you sell it, you got to pay taxes. But if you die, your heirs get the step up in basis and nobody pays taxes. So if this part of your portfolio is going to go to your heirs, you need to have a strategy of long-term investing and buying and holding. It's going to be much more efficient for you and your heirs. So there's all of these strategies we need to pull in when developing this portfolio and understanding what types of investments go where, okay? So designing the portfolio, we created this thing called Retirement's Hierarchy of Needs. It's a pyramid, okay? Not a pyramid scheme, just a pyramid based on Maslow's hierarchy of needs. Pretty basic. The bottom line is the foundation is the most important part of your portfolio. The foundation of the pyramid is your guaranteed income. Make sure you have enough guaranteed income to pay your base living expenses. That's always priority number one. Fix this problem first, then move on. How much cash should we have laying around doing nothing? Well, it's 1 year's worth of expenses that our income doesn't cover because we can't be fired anymore, right? In our working years, it was obvious we should have an emergency account just in case we quit or get fired or whatever, we lose our job. And now we have enough income to pay the bills for the next few months while we go find another job. There's plenty of reasons to have emergency money in our working years, but in our retirement years, we can't be fired. So it changes the dynamic of this bank account. This bank account is there to have enough money to go enjoy the year, plus a little cushion for some emergencies, the air conditioner going out, things like that, okay? That's what it's there for. And then once a year, we're going to use our investments to refill it. That's how you become more efficient in retirement. Stop pulling monthly from your investments. It's ridiculous, okay? Now, we have our safe investments versus our stock market investments, risk investments versus, safe, boring investments. That's just the stigma. They're not all boring. So the mix is different for every single person, but when it comes to dealing with a volatile market, we learned this in the pandemic. If you haven't learned this yet, I don't know what better example than the pandemic. You can learn it in 9/11, you can learn it in 2008, you can learn it. But the pandemic was the perfect microcosm to teaching people that leaving your money in and not panicking is the best idea. No one knew that was the bottom when it happened. No one knew when to put it back in. Everybody could have pulled out their money in the stock market. Everybody could have hit sell at the top of the market, or they're pretty close to there. When we saw that pandemic rolling in, it was really obvious we needed to get out of the stock market. But nobody knew where to put it back in. And that rocket launch, if you missed the first few days, you missed out on quite a bit. So the people that just let their money go down and back up are the ones that fared the best, believe it or not, okay? Trying to figure out where to buy back in is always the hardest part, especially with crazy events like that. Those black swan events that we can't predict. We see them, come in a day or two in advance, we can hit sell, but we never know where that bottom is. So don't try to treat your portfolio like this, especially in retirement, okay? Be careful about that emotional investing. We know it's going down, but the problem is we don't know when to get back in. So let it go. Okay, you should have a portfolio that you're comfortable with that happening, meaning you should have enough in real safe investments that don't go down when the market's crashing, and you should have the amount in the stock market that you're comfortable with going like this while the rest of your portfolio marches along. Okay, that's the idea of this, making sure that we've got a portfolio that we've got confidence in, that we know that, hey, only 50% of our money's in the market. If it went down 40%, we really only lost 20%. And if our safe investments are still growing a little bit, that's making up for that, right? We need to have that perspective, and we need to understand what our portfolio is doing. So that's important. Build from the bottom up, prioritize your safe investments in your IRA as you head into retirement, and then prioritize the market, the growth-based investing in the Roth. Use that non-qualified after tax as the buffer for your own personal risk tolerance, okay? And then if you got more money and you know what to do with, then go have fun. Precious metals, you can go buy extra real estate, you can do private investments, you can get life insurance to transfer the wealth. There's a lot of fun things you can do once you realize that you got more money and you know what to do with. All right, everybody, hopefully that helps. Part 3 is coming next week. That's when we're exploring some of those things that we need to pay attention to when it comes to solving problems in our portfolio, especially if we don't have enough money, to meet that math that I talked about early on. So let us know if we can help out in any way. We're available nationwide, actually worldwide now. We have clients moving all over the place. It's interesting times right now. Portugal is a very popular place right now. So we're always happy to help out with anybody's needs of any kind. Give us a call, shoot us an email. You can even use the comment section below. Just know that's public, but shoot me questions, email, or comment, and I will reply. If we can help out, give us a call. Come back next week and watch the rest of this series. We'll see you soon. Thanks a lot.